Hey everyone out there, welcome back to my channel. Today we're discussing HIMS and HERS stock. We're gonna take a look at an updated version of my discounted cash flow model, but also look at the overall market opportunity for the longer term. So first part of the video is gonna be like taking you through the DCF, the discounted cash flow model, to see where the price could be within the next 12 months. What is the fair value for the stock at this moment in time? But then the second part of the video, we're gonna look into the actual market opportunity, look at what has changed there in terms of my forecasting and my model. Where do I see HIMS and HERS being in 5 to 8 years time, 2030, around that time frame? Where could the stock price be potentially go? So let's head into this. As you see here, I've got a price chart of HIMS and HERS, ticker symbol HIMS. Obviously, if you're invested into it, if you've heard about the HIMS and HERS, you know that the stock has been going down for a while now, from highs of around 15, reached in June 21, to now below $5. We are around $4 range. In the last few months, it has been going around that $4 to $5 range. So this is where it seems to be pricing in the current situation we are in right now. And this is what's been happening. And the reason why it has been going down is obviously a lot of macro factors here that play into it. And this is something we want to talk about today as well, to see how these macro factors actually affect the valuation of HIMS and HERS, especially because it's a growth stock and it is not profit making at the moment, basically requiring more capital investment, more equity to be reinvested for it to grow, to be eventually profitable at some stage. So this is one of the key factors we're going to look at today. But yeah, it has been going around that area and it doesn't seem to be wanting to go up anytime soon. And the more bad news we had around inflation fears, then interest rates going up as a result of that, and then obviously also geopolitical issues there, which all do affect inflation numbers, which then affect interest rates, which eventually comes down to valuation models such as for HIMS and HERS that we're going to look at today. First thing we're going to talk about is if we go to my valuation model that I've shown you in previous videos as well, so you can take a look at that back there, but I've kind of updated it a little bit, tweaked it a little bit to see what is the current market pricing in and why is the stock price as low as it is. So if we look into this part here, the assumptions part, so in terms of numbers, I haven't actually updated anything here. I've left that the same way. So we're saying that sales are consistently growing year over year, and that they reach around $1 billion in 2026 with a profit, with an EBIT of $160 million. That's my, I wouldn't call it conservative, but that's my estimate, where it's kind of like a streamline there. And the problem with HIMS and HERS, obviously, as well, as it's a younger company, unknown company in the market, quite newly listed as well. There's a few analysts now covering the stock price itself in terms of where it could be going, but there's not a lot of detailed numbers there available. So we have to basically do our own numbers here. We have to see where is the market for the telehealth space, and where could HIMS potentially go in terms of their revenue numbers. And then in terms of profitability, we do also have to make assumptions here, which might be wrong overall, and we might be too optimistic. But I do think that I wasn't too optimistic in my cash numbers, in my profitability numbers. If you look at them here, basically I'm saying that there's no free cash flow until 2024, which might be sooner, but it's yet to be seen. So yeah, I haven't changed any of that. If we look at that box here, the assumptions, that's where I made a few changes, and I'm gonna talk you through what I actually changed here. So first off, we're starting off with a discount rate. So the discount rate is used to discount those future cash flows to a present value. So whatever they make in the future years, you're discounting this, take it basically as an interest rate on your cash balance, but in reverse. So you're basically saying, okay, my 5,000 in year 5 is worth 3,000 at the interest rate of 15%, for instance. So this is what we're doing here. So we're applying an interest rate to the future cash flows to bring it back to today's value, because that's basically also incorporating the required rate of return of investors. So the way this is calculated is called the weighted average cost of capital. So what it does here, looks like a complicated formula, but if you actually explain it in plain words, it's not really all that complicated. It basically says what is the ratio of debt to equity in this company, and what is the cost for each? What is the cost for debt? If the company requires debt and needs to pay the interest rate, what is the cost there? And what is the cost if the company needs additional equity from investors to be paid in? What is the cost of equity? And the cost of equity is pretty much just the return that investors are seeking. So if you're investing in something, you have a minimum required return on your capital, and that's the cost of the equity in that part. So basically, if we're saying there's 20% of debt in the company and 80% of equity, you would times the 20% of debt times the cost of the debt, which might be 5%. So 20% times 5%, and then you add that up with the equity portion, which is 80% times the cost of equity, which might be 10%. And then you come up with a weighted average cost of capital, which will be the total interest rate that you're applying to your discounted cash flow model, which discounts the future cash flows to see if at that required rate of return, which is the cost of capital, does it make sense for us to invest right now? Do we actually get more than that cost of capital? Then only if we get more than the cost of capital, we're making money basically. So, and important to notice is obviously that HIMS doesn't have any debt, so there's highly dependent on equity and is equity funded, and there will be also dependent on more equity funding going forward. Then at the moment we're obviously not making a profit, although the gross margins are strong. There's no profit at the moment, so equity investment and more equity investment is required. So that's why it's kind of important to look at the discount rate here, to really understand how it's derived and how it impacts the valuation of a stock like HIMS. And then, basically that WACC formula that we just seen, one part, as I just mentioned, is the cost of capital. And to calculate that cost of capital part, so to say, okay, if I need more equity to be reinvested, how much does the equity cost me as the company, right? And to determine that, we're using something called the capital asset pricing model, the CAPM, which is a combination of a few different rates and risk-free rates and sensitivities, which gives you a total required expected return, which is the cost of capital. Because if you think about, if you're investing in something, there is no cost as such. There's no monthly interest rate payment that you get, but you as an investor, you expect a return, and the return is expected based on the current market. So it does factor in things like what is the risk-free rate of interest right now for this market. So for instance, let's say it's 1 or 2%, because that's the risk-free rate if you were to invest with a bank into bonds or anything that's considered risk-free. What would you get? And obviously, if you invest as an investor into an individual stock in a young company, you want way more than just that risk-free rate, because otherwise you could just put your money into that risk-free asset without the risk, as it says. But obviously HIMS or HIMS stock or HIMS related stocks, they have way more risk attached to them. So you require what's called a risk premium, which goes above that risk-free rate, for you to be, basically compensated to take on additional risk. And that's where, it's important to understand how this affects something like a stock valuation for HIMS and HERS, as that risk-free or that risk-free rate has changed, but also the risk premium has changed. And the way it changed for all the growth stocks is that, that risk-free part has been adjusted upwards as interest rates are raised by the government and bonds have better yields. But then also the beta part here, and the beta, which they say is sensitivity, it's basically how volatile the asset reacts. Usually that wouldn't change a lot, because most of beta numbers you find for companies out there are from the average of 5 years of data of sort of volatility measurement. So you would assume that it doesn't change a lot over the long term. It should equal out and it should be quite stable for, you know, a lot of them. But things like HIMS and HERS, there's not a lot of data. So as soon as we have huge drawdowns that we did have in the last half year, the beta there goes up. So the higher that volatility, the higher it goes up and down, the higher the beta for this asset. So in that case, you would assume that the beta is also quite high for a stock like HIMS and HERS. And then the other element here is the expected return of the market. So that is basically saying, what is the market, what is the average expected return of the market right now? And that goes obviously up. There's considerably more risk out there and more, you know, basically uncertain times. The expected return of the market goes up, increasing this number even further. So this is a combination of, okay, my expected return is maybe 6-7% minus the risk-free rate, as we already added that here. So that is actually the part of that risk premium that we're talking about. And the risk premium obviously goes up as the market thinks it's becoming riskier to take up an investment. You need to pay the market participants more to actually participate and invest in your types of assets. So that's why pretty much all of these have been going up. And I've done, you know, an analysis and basically said, okay, I think that based on that, an interest rate or discount rate here, as we call it in the discount cash flow model, of 11% is appropriate, just based on calculations that came up with the CAPM calculation at the moment. So this is what the market is right now pricing in. And I just wanted to show you how this would actually affect it. So before that, I was already going there quite conservatively with 10%. That was already, you know, when I was drawn down and there was already increased volatility in the market. We had 10% here, which led to an upside of roughly 45% in the stock. Again, giving an intrinsic value of around $7.50. And then you can see that only 1% up, which is, yeah, it's massive in terms of cost of capital, has an impact of almost 50 cents on the stock price. So now expected return or intrinsic value is below $7, upside only $34, upside only 34% at the current levels. And what I've also done is I've adjusted down the EV to EBITDA multiple, as other comparable stocks have taken a hit, such as Teladoc. If we look at that actually here for in a second, because if you look online, you don't really see any competitors here for Teladoc, because it's just not yet really built out well, and they haven't really picked up, you know, what Teladoc, what HIMS is doing, and how it plays in, and who are the competitors. So we'll just have to look manually into TDoc here, look at the competition there. So we have a lot of other companies that are doing similar telehealth services. We see that Teladoc itself is trading at a 25. So that's what initially I thought, but I'm just thinking that it would be more appropriate to go with a mean value here, which I've actually rounded up as well, as I think that there is a stronger support for a stock like HIMS, but I wouldn't give it as premium as for Teladoc, given that they're just a market leader and they've been established for a number of years. And I do think that they deserve a better premium, as they have been building out this market position, and HIMS is quite relatively new. So we have to be a bit more conservative there, giving them basically a 15% EV to EBITDA multiple, and that has, you know, obviously significant effect on the potential upside that we're seeing, because, you know, if you're giving this a Teladoc type multiple, then your upside, you're looking at almost a $10 stock price, and your targeted price upside is 90%. So you can see that how small assumption changes here in this table can have a significant impact on the expected return or expected price intrinsic value calculation here, and as well as obviously here the financial numbers as well. But I do think that percentage changes here are much more significant to the actual intrinsic value calculation than just changing a bit of the profit numbers here and there, because overall I do think that it's realistic that we achieve this, but we have to be realistic here on that side, and this is just what the market is doing right now. If we're in a huge bull market and we come back and the discount rate might goes to 9% and we are ready to pay a 25 multiple for a company like HIMS, if they keep being performing well, then obviously the target upside here goes to 117%, which would be equating a $11.20. But that's not the market we're in right now. So we have to just work with what's the market giving us right now. What's the market? Because we can't just make the market just because we are investing with, we see the long-term vision. At the moment, this is what the fair value is for HIMS, because those are the cost of capitals, and we know that HIMS will need cost of capital in addition to what they've already have. So this is just what we're calculating here right now, and this is just what the market is. And still, you're getting an upside of 34% for something like in HIMS, which equates a nice, decent return, not outstanding, but at the current market, as long as it's not turning around, this is what we have to live with. And if we look at these three targets from analysts, what I noticed is very positive is that we had initially last year when the stock IPO, we had 4 analysts, so then it's been increasing steadily. Now we're looking at 6 analysts for February, for March, and then for May 22. So that's pretty good. So increased interest there definitely to be seen, and they have a stock price median here of roughly $7.75. So roughly $8, and if we compare that with sort of my model, I get around the $7. So yeah, they've actually been a bit more optimistic that I might have applied 10% here or a higher EV to EBITDA multiple, which would lead to 750. I get similar price targets, to be honest, and I think that even then it's still looking quite good and still undervalued at current levels, and the market has been pricing this too low. Because if we say, okay, so the market is pricing HIMS at $4.30 right now, right? I have to actually update this one as well. So yeah, market is pricing this as $4.30. So at the current levels, if we go back to my one, I would actually get a 61% upside. And if we think about, okay, how does the market price this in? I mean, you almost have to go through 15%. This is it. Yeah. So you have to get a 15% discount rate, EV to EBITDA multiple at 10. And then with those numbers, we're arriving at that current intrinsic value that the market is pricing in. I think that's just how you can see that the market has just been over discounting it, discounting types of this company way too much. That even though when I be more aggressive here, my target upside now is still 60% overall from current price levels, and EV to EBITDA I've also reduced drastically, still 61. If we're giving this a 20, if the market comes back like this, we're getting a 94. If we're getting a 25 multiple similar to Teladoc, we're looking at an upside of 127%. So yeah, definitely even at those realistic and conservative prices, which equate sort of the market situation, you're looking at a massive upside, which definitely will outperform the market. If you have a 60% upside growth for the next 5 years, you're looking at more than 10% return. So you will definitely outperform the market. And in terms of my long-term model, that really hasn't changed at all. With just assuming basically that HIMS in 2026 or 2028, so basically 6 years from now, will have a market share of 0.5% of the telehealth market, which means that they're almost making no progress at all with their market share, which is highly unlikely, right? But even let's say we assume that they have that same market share, around 0.5% of the telehealth market, just because the telehealth market is growing so much over the next few years that the market cap will be around $15 billion if they can keep that same market share that they have right now and keep expanding along with the telehealth market. And obviously, I don't have to tell you how much of an upside that is, $15 billion. And right now, I think we're looking at, we're definitely below the $1 billion valuation right now. Yeah, market cap at the moment is looking at around $900 million. So just think about that upside potential over the next 5 to 6 years, going to $15 billion. So that's more than a 15x from here. So yeah, hopefully this was helpful and hopefully it wasn't too complicated. I tried to kind of explain to you why the current market dictates what the interest rate is going to be. And that interest rate dictates basically the discounted cash flow model and the results we're getting from that model. And hopefully this will shed some light on why the stock price has been falling down, but also pointing out that $4 might be a little bit too low here, and the market might be going a little bit ahead of themselves, pricing in too much of a negative sentiment going forward. And if that reverses, there might be a mean reversal for stocks like HIMS and technology-related stocks, as we see that the discount rate is not as bad as we assuming, because obviously we saw that at the current levels, we're basically assuming a 15% discount rate, which seems to me way too much in my opinion. So yeah, hope you enjoyed this video and see you next time.